Financial management, management of working capital. What is working capital? Working capital typically means net current assets which are available for day-to-day operating activities. It normally includes inventories, receivables, cash and cash equivalents, less payables. Therefore, the working capital means it includes inventory plus receivables plus cash less payables. Investment in working capital. Working capital needs financing just as does the investment in machines. If you invest in fixed assets, the company will generate profits. Therefore, investment in working capital does not directly earn profits. If this were the only consideration, then it would be better to invest all the finance available in fixed assets and to keep working capital to an absolute minimum. Therefore, the company should identify optimum level of working capital between the profitability and liquidity. The company therefore faces a trade-off between profitability and liquidity, and it is up to the financial manager to decide on the optimum level of working capital and to ensure that it is managed properly. On the other hand, all companies need some working capital in order to keep the business running. Customers should be allowed to buy on credit, otherwise company would lose business to competitors. Companies need to carry inventories of finished goods in order to be able to fulfill demand. And also they need to have a short-term cash balance in order to be able to pay their bills. Whatever the level of working capital the business decides to hold, it has to be financed from somewhere. The business must decide whether to use short-term or long-term finance. Long-term finance is either raised from equity in the form of share issues or from long-term borrowings. Short-term finance generally involves overdraft borrowing or delaying payments to payables. Short-term finance is often cheaper, although not always. Interest rates on overdraft can be very high, and delaying payments to payables can involve the loss of discounts. However, short-term finance is risky as it is payable on demand. In the past, it was generally thought that since working capital involves short-term assets, it should be financed by short-term finance, whereas fixed assets being long-term should be financed by long-term finance. Working capital can be further divided into permanent working capital and temporary working capital. Permanent working capital means working capital which remains fixed in the long term, whereas the temporary working capital means the working capital which fluctuates on a day-to-day basis. Permanent working capital being long-term should be financed by long-term sources of finance. Temporary working capital should be financed by short-term sources of finance.